Welcome back to ATRE. This is the third part of the black capital case. In this video, I'll wrap up the case by building out the IRR waterfall and the sensitivity tables. First off, the model should distribute the right cash flows depending on our refinance toggle. If the toggle is set to yes, the model should pull refinance cash flows. If the toggle is set to no, the model should pull acquisition cash flows. For both, cash flows should only be positive, which is why I use the max function. Building out the structure for the waterfall here, I choose to build out this waterfall from the perspective of black capital. Our beginning balance is the last month's balance. Of course, the amount of contributions could also change depending on the debt assumption. So I use the same structure as I did for the cash flows here to calculate contributions of black capital. The IRR accrual is the same as used in past equity waterfalls, multiplying the beginning balance by the monthly interest to accrue our 12% return. I use the Boolean of the ending balance not equaling 0 so that the accruals don't continue after the model jumps to the next waterfall tier. My paydown is either the LP's 90% share of the cash flows or whatever's left to pay off the equity waterfall in the case of a capital event. Sum up the ending balance and the hurdle structure is complete. And as you can see, our equity waterfall zeroes out at the capital event, as it should. The LP and GP cash flows for Tier 1 are straightforward. For the LP, it's the distribution from the waterfall since the waterfall is from the LP's point of view. For the GP, it's the GP's pro rata share of the distributions. And then for total cash flow to the LP and GP, I use the same strategy, with the GP taking its pro rata share calculated by using the proportion of GP to LP investment. Here I calculate the IRR, making sure to use compounding to find the appropriate internal rate. Because the second tier of the waterfall uses a simple profit share instead of an IRR hurdle, the tier is much easier to construct than Tier 1. For LP cash flow, I multiply the cash flow to Tier 2 by the LP's share, or 70%. Then for GP, I use the same formula, except with 30%. For the LP cash flow, I sum both distribution tiers, which also includes contributions from the Tier 1 calculation made earlier. I do the same thing for the GP cash flow. I need an extra row here, so I move the pro forma down a row. Copy over the IRR table and the equity waterfall is done. Now for building these sensitivity tables. The case asks us to sensitize LTV, cap rate, and exit year. But I figured it would be helpful to take the sensitivity a step further and sensitize based on refinance decision as well. As you can see, refinancing boosts returns as is expected. In this situation, refinance allows for a larger loan size once the property stabilizes, so there's even less equity in the deal, juicing up the IRR return. I can also sensitize the inputs of the refinance decision itself, this time based only on the refinance inputs of interest rate and loan to value. Format here to make the table a little prettier, and I choose gray just because the case is called Black Capital. And that's pretty much the case. I could keep building the sensitivity tables based on any input, whether that's the refinance month, hold period, or start date for the tenants. The sensitivity tables are very powerful tools after all. In any case, thanks for watching. I hope you enjoyed the case.